The stock market is healthier than it seems. I know it doesn't feel that way right now, and for good reason. So what are the markets really telling us? Look, we made it through the Fed meeting and the labor report this past Friday, which showed strong job growth of 253,000, when Wall Street was expecting a growth of 180,000. I'm not surprised the market went higher on Friday because a strong jobs market doesn't necessarily mean higher inflation, so long as productivity increases. After starting out this past week with a downward move, the markets rallied on Thursday and Friday to close out the week mostly up. But will this upward trend continue? In my video a week ago, I talked about how one set of metrics were pointing to a downward move, while the other set of metrics were pointing to an upward move. So let's take a look at what we're seeing now and if the metrics are telling a more definite story or not. Well, if we look back over the past week, you can see the markets really struggled on Monday, Tuesday, Wednesday, and then on Thursday they tried to rally, and then Friday, after the jobs report, they actually rallied very nicely here. So this is starting to look pretty good. And what about over the past month? Well, you can see that the NASDAQ finished in first place, followed by the S&P, followed by the Dow and small caps, and ARK is playing catch up here. So we have a ways to go. And if we look at the markets year to date, they look great. I mean, this is very healthy. You've got ARK and the NASDAQ leading the way, followed by the S&P, and then followed by the Dow and small caps. This is what you want to see. And these are very healthy returns over the last, 4 or 5 months. We're into the 5th month, so this looks great. And what if we look at bottom dynamics? Now, I've changed this chart just a little bit here. So in the past, we looked at bottom confirmation, bottom forming indicators, what we called confidence level. I've changed that to risk confidence. Then I've added safety confidence. And then we still have the S&P 500 here as the big black line. And why did I add safety confidence? Well, the risk confidence tells you a story here. So when it's high, you can see that things are good. The market was moving up. It was sort of high here while the market was moving up. But the safety confidence, you'll see, was very low down here as the market was moving up. But when the market was moving down, you can see that the safety confidence shot up here as the market collapsed. So this gives us another indication as to what's going on in the market. So where are we right now? Well, you can see that we had a nice rally here. You can see that the safety confidence shot up here, and look what happened. The market was going up, and then it started flat topping as the safety confidence increased. So this says that people are putting more of their emphasis on safe holdings, less on equity holdings. While it continued higher, it didn't go up as drastically as it was back here. And now where are we? Well, safety confidence dropped way off. The market shot up, but now safety confidence is going up again, and we had a pullback here. So based on what I'm seeing here, we've got risk confidence dropping while the market goes up. That's a conflict. That tells me by itself that we're likely to have some downward pressure over the next couple of days. And then you've got the safety confidence moving higher here. So that really doesn't look good for the short term, but we'll have to wait and see what happens. But if we look at risk versus opportunity, this looks great. I mean, you've got the risk level in red down here below 70. Usually when it's below 80, it's good. Now it's below 70. I like that. And then you have risk acceleration down here at 10. That's unheard of. That's really, really, really low. And then you combine that with the opportunity level, which is shooting up here and is above 70, well above 70. This all looks very, very good going forward. And what about equity versus safety? Well, this tells a different story. So if we look at the NASDAQ 100, you can see that back here a few weeks ago, it dropped from 3rd place to 5th place. Then last week, it shot up to 1st place. And then this past Friday, it was still in 1st place. So this looks very healthy, doesn't it? You want the NASDAQ to be right at the top of the pile. But what if we look at what cash is doing? This is the part that scares me a little bit. So if we look at cash moved up to here, then it went sideways. But now look what it's doing. It's up here right behind the NASDAQ 100. This scares me a little bit. I don't like seeing cash anywhere in the top half of this ranking list. So this has got me a little bit worried, especially in the short term. And then gold has been all over the place. So gold started out here, it dropped back to here, then it dropped to the bottom, very bottom, and then I guess there's some more bank contagion this last week. Now it's up here in third place. So we have the NASDAQ 100 in first. This is great. We've got cash and gold 2 and 3, not great. Intermediate bonds in 4, not great. And then finally followed by the S&P 500. And then we also have an unhealthy Treasury market. We have the longest duration Treasuries in last place, and the next longest one's in 8th place. So this is a not healthy Treasury market. So what kind of story is the Dow Jones Industrial Average buying and selling pressure telling us? Well, you can see we had a very nice rally here, and then things flat topped as they did for the S&P 500, and then we've had a bit of a pullback here. And you can see while things were rallying, the buying pressure, this solid gray line, was well above the selling pressure, which is this solid orange line. But you can see those flipped here. Now they've been just kind of noodling sideways. Really not a lot of information here. And the S&P 500 buying and selling pressure, again, nice rally. Buying pressure well above the selling pressure back here. But then things flat topped and pulled back. So really nothing definitive here as well. And what about the NASDAQ 100? Similar picture. Nice rally, buying pressure above the selling pressure, and really nothing definitive here yet. The Russell 2000, very similar picture, no pulse at all. In fact, in general, no pulse at all. This has been pretty much going sideways. And then if we look at ARK Innovation, sideways to down, this is showing some downward pressure here. You see the selling pressure staying stubbornly above the buying pressure. Although if this continues, the buying pressure will probably move up. So in terms of buying and selling pressure, I can't really give you a sense of where this is going to go. It has no pulse. It's just kind of treading water here. So we'll have to wait and see what happens next week. Now let's take a look at sector rankings. These tell you kind of over a longer view. So these take a longer view. They move more slowly. But what you can see is this top portion is what these looked like last week, a week ago, and then the bottom portion is how they looked this past Friday. And you can see where we are now is we've got Bitcoin ranked number 1 as it was last week. We've got technology, consumer discretionary here, ARK Innovation here. This is very, very healthy looking. This shows a healthy risk appetite. And if we compare that to a week ago, gold has moved down. I like that. Consumer discretionary has moved up. Like that. Cash is staying put. I'd like to see it move down that way. And treasuries have gotten a little less healthy, as we pointed out earlier. So this in general looks like a very healthy risk appetite. So what if we look at sector rank acceleration? Well, these move a lot faster. It's kind of a shorter view. And you can see that this week, we have ARK Innovation ranked number 1. This is great. We've got emerging markets, technology, emerging companies. Now, I don't like the fact that consumer discretionary moved lower in the rankings from last week. I do like the fact that consumer staples moved a lot lower, so that's a good thing. And cash moved from up here all the way down here. Now you can see over the shorter term, we have 20-year treasuries looking a little more healthy, and gold is all the way at the bottom. So take this for what it's worth. I see a fairly healthy risk appetite here, and over the long term, hopefully this will hold. And if we look at the Treasury action over the last week, you can see really a struggling market here, kind of flat to nowhere with the longest duration, highest risk Treasuries finishing lower for the week. So not a good look for Treasuries for the most part, except you can see that the longer duration ones are trying to move up here. They have a nice upward slope. And what about that inverted yield curve? Yeah, well, we were inverted by 1.1% or 110 basis points back here. You can see that things tried to correct a bit. Then they became more inverted into last week. And now they're shooting up again. But we're still 41 basis points inverted. We've got a long way to go to get above zero here. But it's moving in the right direction. So maybe with the Fed only raising 25 basis points this last week and indicating that they're ready to pause if things look good, maybe this will finally start to revert and become uninverted. And what's buying and selling pressure telling us? Well, if we look at intermediate treasuries, you can see the buying pressure is well above the selling pressure, and there has been a slight move higher here. In what I call intermediate to long treasuries, 7 to 10 years, the selling pressure is above the buying pressure, but we have had a move up here. And what about long bonds, the 20-year bonds? Well, you can see nothing definitive here. There's really kind of no pulse in terms of buying and selling pressure. And you can see that in the price action. It's kind of going sideways to down back here and a little bit upward if you look from back here, but not really moving much at all. Now, what about gold? You can see gold had a huge rally back here when the banking contagion first hit. You can see this buying pressure was way above the selling pressure. Now it's been moving pretty much sideways. It started to move up here, but then the buying pressure just collapsed this past Friday and the price moved lower. And how's Bitcoin looking? Well, Bitcoin had a nice rally, kept continuing higher. Now it's kind of pulled back and is starting to move higher again. And you can see that the buying pressure is well above the selling pressure, but it is moving lower. And what can we expect from the Fed the next time it meets in 5 weeks from now? Well, currently the markets are projecting that the Fed will not raise rates. There's a 91.5% chance, or vote, if you will, that the Fed will leave rates where they are. And then there's a very small chance here that the Fed will raise by 25 basis points. But these will change over time. 5 weeks is a long time from now. So this is basically kind of a voting system based on the futures market. Yeah, this has a long way to go. So this could change drastically by then. So as you can see, if we look over the longer term time frames, like year to date in the past 6 months, the equity markets continue to look healthy. And in the shorter term, they appear to look a little wobbly. But from the indicators, it looks to me like the equity markets could see some downward pressure next week, probably the early part of the week. And there's plenty to worry about with a dysfunctional Congress who needs to come to an agreement on the debt ceiling. That's the big wild card over the next several weeks. Is it scaring you? It's scaring me. But we're staying long in our investment bias for now. I'm Calvin Rose, and thank you for watching Invest Smarter this week. That's all for now.